You ever feel like those CEO letters, and annual reports are just, how do I put this, corporate fluff?
Yeah.
Well, get ready for the opposite because we are diving deep into Warren Buffett's legendary letters to Berkshire Hathaway shareholders,
Oh, wire.
specifically from 1979.
Okay, I love this one.
It's not just a snapshot of that year, which is fascinating in itself, but it's packed with insights on investing in business that are still relevant, even today.
Yeah. This letter, it's like a masterclass in cutting through the noise. And I think what's so fascinating is how Buffett challenges conventional wisdom right from the get-go. Like, he questions this obsession with earnings per share as the be-all and end-all measure of a company's success.
Which, come on, everyone gets caught up in those per share numbers.
Oh, absolutely right. It's like the headline number. But Buffett's arguing that it doesn't tell the whole story.
It didn't even come close.
It's like looking at a piece of art and only focusing on one tiny detail. He's saying, step back, look at the whole picture. Look at the overall return on equity capital employed. How effectively is a company using its resources to generate profits?
It's true because a company could double its earnings per share and everyone's like popping champagne, but what if they had to double their investment to get there?
Right. Suddenly the picture's not so rosy. Like that old saying, you have to spend money to make money, but how much you have to spend, that's the key.
That's the million-dollar question.
Exactly. And Buffett, he uses this brilliant analogy to really drive this point home. Compares it to, get this, a stopped clock. Even a stagnant investment can look like it's growing if the earnings are consistently plowed back in.
So you're telling me a rising earnings per share number doesn't necessarily mean a company is actually, healthy and thriving.
It's like those misleading social media accounts.
Yeah.
Making people look way more successful than they really are.
Oh, too real.
And this leads us to one of the most, if not the most, famous concept from this letter, the investor's misery index. This is where Buffett gets real about the silent killer of returns, inflation.
Okay, yeah. Big topic these days. A lot of people are thinking about inflation with prices going up on, everything.
Imagine this, you're earning a 20% return on your investments, right? Sounds fantastic.
Amazing.
But inflation's running at 15%. And then to top it off, you're paying taxes on those gains. Suddenly that amazing return, not so hot.
Yeah, you're basically just keeping pace with the rising cost of, a loaf of bread.
It's not just about growing your money. It's about growing your purchasing power.
So how do we avoid this misery that Buffett's talking about? Does he gets into that in this letter?
Well, and he does. This is where his thinking really challenges the whole buy low, sell high mantra. He talks about the allure of those turnaround situations, finding a struggling company on the cheap, hoping to make a killing when it recovers.
Sounds good on paper.
Right.
But I'm guessing Buffett learned that it's not that simple.
Yeah, he learned it the hard way. He uses his own investment in Wambic Mills, a textile company, as a cautionary tale. Classic turnaround situation that just didn't pan out the way he'd hoped.
I kind of love that he admits to making mistakes. It makes his concepts feel way more, relatable.
Yeah, even Warren Buffett makes mistakes.
Yeah.
We all do. But it's about learning from them, right? And what he learned from that experience is that sometimes the smarter play, the smarter strategy, is to invest in those easy businesses, the ones that might not be super exciting, but they have this inherent strength, this resilience.
Okay, give me an example, because when I hear easy business, I'm thinking lemonade stand.
Think about companies like Coca-Cola, those consumer staples, those brands that are just always on the shelves. They might not be the flashiest investments, but they have strong brands, consistent demand, and a track record of weathering economic storms.
The kind of companies that just keep chugging along, even when times are tough.
Exactly. And this kind of leads us into another major theme in this letter, the insurance industry. This is an area Buffett knows like at the back of his hand.
He's really into insurance.
Oh, yeah. And he dedicates a significant chunk of this letter to discussing both the opportunities and the potential pitfalls.
And this is 1979, so he's basically gazing into a crystal ball about the future of insurance.
He's remarkably prescient in some of his predictions. He starts by saying that the insurance industry is heading for a challenging period with higher than expected combined ratios.
And combined ratios, just for those of us who, didn't go to insurance school, what does that even mean?
Basically, for every dollar an insurance company takes in from premiums, they're paying out more than $1 in claims and expenses.
Oh.
Not exactly a recipe for success.
That's like what? Setting fire to your profits?
Right. He was particularly wary of the reinsurance business, which is basically insurance for insurance companies.
Hedda.
Right. He believed it was becoming increasingly competitive and risky.
Yeah.
And, looking back, it's almost like he's foreshadowing some of the challenges the reinsurance industry would face in the decades to come.
So he's not sugarcoating it. He's like, hey, there's some, potential storms ahead. But even though he's like kind of sounding the alarm bells, he's not saying all insurance is bad, right?
Absolutely not. No.
Okay.
He emphasizes that while the industry as a whole might be facing some headwinds, there are still opportunities for those who play the game skillfully.
Okay.
He highlights the importance of skilled underwriting, which is basically the process of assessing risks and setting premiums. It's about being disciplined and selective, not just chasing every piece of business that comes along.
Don't chase those pigeons.
Exactly.
They're dirty.
He highlights some of the folks within Berkshire Hathaway who embody this disciplined approach, like Phil Leach, Milt Thornton. They demonstrate that even in a tough industry, success is possible with the right approach, the right expertise.
It's not just about the industry. It's about the people running the show. Which kind of leads us to another really fascinating section of this letter. His thoughts on the bond market, especially in an inflationary environment.
Yes. This is where that investor's misery index we talked about earlier comes back with a vengeance. Buffett goes into this really thought-provoking critique of long-term bonds, especially during periods of, high inflation.
You're like, what's that saying? A penny saved is a penny earned. But Buffett's basically saying with inflation, that penny you saved might be worth a whole lot less tomorrow.
Exactly. And he uses this really vivid analogy to kind of illustrate the problem with long-term bonds when inflation is high.
Yeah.
He compares it to setting a fixed price today for, let's say, a box of C's candies, one of his favorite things.
Of course.
That you'll receive years down the line.
Yeah.
But here's the catch. If inflation takes off, that fixed price you set, it's not going to get you nearly as much candy.
Ouch. Talk about sugar crash. Suddenly those bonds are not looking so sweet.
Not so much. He's challenging this whole idea of locking in a fixed return when the purchasing power of that return is constantly being chipped away.
It's like setting sail in a boat with like a slow leak. You might stay afloat for a while, but
eventually, yeah.
You're going down.
And Buffett, to his credit, he's honest about his own missteps in this area.
Oh, really?
He talks about how even Berkshire Hathaway has taken some losses on its bond portfolio because he admits he didn't fully grasp the severity of inflation early enough.
That's huge. He's basically saying he didn't see the inflation iceberg coming.
Yeah.
Which, I don't know, makes me feel a little bit better about my own, investment slip-ups.
It shows a remarkable degree of humility and willingness to learn from those mistakes, even when you're, Warren Buffett.
Right.
But what's fascinating is how he adapted his approach.
Mm-hmm.
He talks about favoring convertible bonds, which kind of offer a bit of protection against inflation.
Okay, break that down for me. What's so special about a convertible bond?
Think of it like an escape hatch.
Yeah.
A convertible bond gives you the option to convert it into a certain number of shares of the company's stock. So if inflation heats up and your bond is looking kind of sad, you can swap it for stock, which tends to do a bit better when inflation's running hot.
So it's like you're getting a little bit of insurance against inflation built right in.
Exactly.
That's clever. And he throws in a little Shakespeare in this letter too, right?
He does. He quotes Polonius's advice to neither a borrower nor a lender be.
Classic Buffett.
It's just great. Always moving in those literary gems.
But he's making a bigger point about debt, right?
Oh, absolutely. He's wary of excessive debt, especially during those uncertain economic times.
Right.
And it goes back to his emphasis on financial strength.
Got it.
He wants companies that can weather the storms, not the ones that are going to get blown over by the first little gust of, economic headwinds.
Speaking of weathering storms, Buffett also pulls back the curtain a bit on his management style, right? Mm-hmm. He gets into that a little bit in this letter.
He does. He's a big believer in this idea of decentralized control.
Okay.
He talks about how Berkshire Hathaway operates with centralized financial oversight, but they give a ton of autonomy to the managers of all its different subsidiaries.
So it's like a fleet of ships. Each ship has a skilled captain, but Buffett's up there on the flagship, making sure, they have the resources, they're going in the right direction.
Perfect analogy.
Mm-hmm.
He trusts these managers to make the right decisions. He's there to provide guidance, allocate capital, the big picture stuff, make sure everything aligns with their long-term vision.
It sounds like a management style that really empowers people, but, doesn't he say that, this approach isn't foolproof?
He does, yeah. He's very clear that any system can have its flaws.
Sure.
But he argues that the benefits, the speed, the lower costs, attracting top talent, they far outweigh those risks.
It's all about finding the right people for the job and then, getting out of their way, which I imagine is easier said than done.
Oh, absolutely.
Especially, with a company as big as Berkshire.
And the approach seems to be working.
It does.
It really speaks to the power of trust and empowerment.
We've covered inflation, bonds, management styles. Buffett doesn't mess around. This letter is dense.
He covers a lot of ground, and it's remarkable how transparent he is with his shareholders.
Yeah.
He talks about the challenges they're facing, the risks. He doesn't sugarcoat anything.
That's right.
It's not your typical, everything is awesome kind of corporate message.
Right.
He's straightforward, sometimes blunt,
Sure.
but always insightful.
Like that part where he talks about corporate reporting practices.
Oh, yes.
He does not hold back.
That's one of the best parts. He's such a staunch advocate for clarity,
Yeah.
conciseness, honesty, and communication.
Yeah.
And he calls out those companies that try to manipulate their earnings or mislead investors with all this, financial wizardry.
It's like he's saying, don't treat your shareholders like mushrooms, okay? Nobody likes being kept in the dark.
He wants them treated like partners,
Right.
Give them the same information you would want. It builds trust. It fosters that long-term perspective that is so key to his whole philosophy. It's not about, just chasing the next quarterly earnings report.
Right, playing the long game.
Exactly. And that leads us to, I think, a really interesting part of the letter. Buffett uses this restaurant analogy. He basically says, you can't please every palate.
Right.
If you try to be all things to all people, you're just going to end up with a revolving door of unhappy customers.
So you're saying investors should be thinking about their investment philosophy almost like it's a restaurant menu.
Exactly.
Yeah.
You attract the right kind of diners, the ones who appreciate your style of cuisine.
Got it.
And for Buffett, that means finding those investors who are in it for the long haul, who understand that real wealth, it takes time to build.
It's about finding your tribe, those who get you, and they're along for the ride.
And that philosophy, it's clearly resonated, right? I mean, look at Berkshire's track record.
Incredible. Speaking of track record, before we wrap up, I did want to touch on one more company that Buffett mentions in this letter.
Okay.
Illinois National Bank and Trust Company.
Ah, yeah. This was kind of bittersweet, because he was actually forced to sell the bank.
Really?
Yeah, some regulations at the time.
Oh, wow.
But he gives this, heartfelt shout-out to the bank's management team, especially its leader, Gene A. Begg.
Sounds like there's a lot of respect there.
Oh, huge amount of respect.
Yeah.
He credits Begg with the bank's incredible performance, their returns on assets, always a top priority for Buffett, as we've seen.
And I'm guessing, that kind of performance, not easy to replace, right?
Not at all. And Buffett acknowledges this. He says filling that void, it's going to be tough. And it highlights this core principle of investing, right?
Yeah.
The bigger you get, the harder it becomes to find those truly exceptional opportunities. It's harder to move a lot of money intelligently.
Trying to parallel park a cruise ship. It's not impossible, but, it takes a lot of skill.
Exactly. And with that image, we come to the end of this incredible letter. And Buffett, ever the optimist,
Yeah.
ends on a note of, I'd say, cautious confidence.
Yeah.
He acknowledges the challenges ahead, inflation, interest rates, competition. But he also expresses deep faith in Berkshire Hathaway, its ability to weather those storms.
And they did all right. This letter from 1979, it's not just some, dusty old document. It's like a masterclass in investing, full of this timeless wisdom, like we were saying, that's just as relevant today as it was back then.
Absolutely. It's
Right.
about finding those great businesses, holding them, being patient, tuning out the noise, and focusing on what truly matters.
Playing the long game. After diving deep into this letter with you, I'm wondering, is there a connection between, Buffett's legendary patience and his ability to cut through all that noise and really focus on what matters?
That's something to think about. Maybe there's a key insight there for all of us, right?
Maybe so.
As we navigate these crazy markets in our own investment journeys.
As always, thank you so much for diving deep with us.
My pleasure.
And to our listeners, until next time, keep asking those questions and keep diving deeper.